So let's get more now on how the Zeta data is coming in. Joining us now is David Steinberg. He is CEO of Zeta Global. And there's some good news here. As I read it, it was kind of weakening for about 6 months. Looks like it now, David, may be starting to firm a little bit.
Yeah, totally right, Brian. For the first time in 6 months, we saw the Zeta Economic Index go from contracting to expanding. It expanded, 150 basis points to 67.7%, which is a very healthy place for the economy to be.
What are we looking at in the Zeta Global Economic Index? Because you've got so many data points looking at all these things for your clients. What are some of the main features of the ZEI that we should be paying attention to?
Yeah, so we're looking at 240 million Americans, everything they're researching, everything they search, all their credit card transactions. We're looking at their sentiment across multiple different categories, and we're ingesting, quite frankly, trillions of signals into the algorithms that then tell us the state of the economy. And right now, it seems like the consumer and the private sector, even though they're concerned about the government shutdown, they continue to spend. They're sort of cutting through the noise. We're seeing categories like financial services, travel, entertainment, retail, automotive, and tech all simultaneously expanding. That's a very big deal. And quite frankly, you're looking at what's going on from a government perspective. You're seeing a positive economic indication.
What they're not spending on is moving. Now, we know there's not a lot of houses for sale, but your index, I'm looking at it, is showing a continued lack either of mobility or simply the desire to or ability to move.
I think it's ability. You saw a contraction to the moving index, and quite frankly, you saw a contraction to credit, both of which come down to interest rates. And, I think that the Fed cutting rates was a mental boost. And I think in the next month or two, we're going to see consumers begin to loosen up as it relates to drawing down credit, which of course is important to our economy, and to moving. But right now, moving, most people either have a low-cost mortgage and don't want to give it up, or can't afford to make that move.
Well, this also goes to another data point that you've got, David, which is credit line expansion intent also falling just about as much, meaning people are just less willing or less able to take on new credit. I would imagine some of that is the mortgages they don't need because they're not moving. But is there also maybe another way to read that? Because like it or not, borrowing and credit are a pretty important part of our economy.
That is the American way, right, Brian? First of all, it fell half as much as it did last month. So it's falling, but it's falling at a 50% rate to what it fell last month. So I look at that as it relates to a positive, but I think a lot of this is tied up in very expensive mortgage cost versus the average mortgage cost that individuals have prior to moving. And as we all know, you can't really take those mortgages with you. So if you're sitting on a 2 or 3% mortgage and you're now looking at a 6 or 7% mortgage, and in markets where housing is already expensive, it's going to cost you substantially more to move. And I think consumers are just not drawing credit to do those types of things.